Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. This week, I'm joined by Zacks Director of Research, Shiraz Mian, to talk about what clues we can get from looking at the earnings season. Second quarter earnings season is just about to start officially, I guess. It's kind of already started, but we haven't had that official Dow component lift off yet from the big banks. But all I keep hearing, Shiraz, is that it's going to be awful and that estimates are dropping. And it's, this is a sign that we're either in a recession or the recession is imminent because of all the cuts to the estimates. So I thought I'd have you on to discuss what is actually going on with the estimates. Can we tell anything about what's going on with the economy? And you and I kind of were chatting about what the data is showing before we started this podcast. And having looked at this data for a couple of years when you've done some other podcasts with me and just in general, I've noticed some differences in this data that I think are kind of interesting that we can talk about too.
Sure.
So let's start off with basically, is it as bad as everybody says?
I don't think it's bad.
Okay.
The what is bad is the year-over-year growth rates. They were positive for the last many years, even though we had a 3-4 quarter stretch in 15-16. When because of oil prices, growth had declined. But on the whole, we have a very long stretch of positive earnings growth, many quarters, double digits. Then last year, we got a huge boost from the tax cut legislation when, unlike what would normally be expected at this stage of the cycle, we got growth rates that are typically associated with the beginning parts of a cycle.
Right.
So
wasn't last year just kind of, it wasn't real? It was kind of fake, even though it is real?
Yeah,
Okay.
it is. So we all understood that the tax cut legislation and the lower tax rates just gave a windfall bottom line boost to corporate America.
Right.
And at the time, while we were in 2018 and we were enjoying the 20% plus growth rates, we could see how difficult it would be in just pure arithmetic terms to have any growth in 2019. And that's exactly what we are seeing. So Q1 was flattish, just a tad bit in negative. And one interesting thing about Q1 was that the fear coming into the Q1 earnings season was that all of these recessionary worries, the global growth worries, the fear in the market was that all of these companies reporting results will paint this extremely grim outlook for the June quarter and the second half of the year. And that had everybody on edge. Estimates for Q1 had come down quite substantially before the start of their earnings season. And then the actual results, while not great, had none of that fear factor. So as we get close to the Q2 earnings season, we are not really seeing that much negative revision. So yes, estimates have come down, but about in line with historical levels. In fact, relative to the recent quarters, the magnitude of cuts to Q2 estimates is actually less than what we have seen over the last few quarters. So all in all, we have a relatively more stable and reassuring setup compared to at least the last earnings season.
Okay. Some of this, what you were saying, reminds me of the retail like a company, a retailer that's doing really well on its same store comparables.
Yes.
So it has like double digit comps for a couple of quarters, and then you get to the next year.
That's right.
And it's really, really difficult to do 10% and then another 10%
That's right.
growth the next year. So if you have 23.3% growth in earnings for 2018.
That's right.
Even to do another 5 or something on top of that would be very difficult.
And absolutely, and that is the reality.
Yeah.
And when you combine this with the fact that this cycle, both economic as well as earnings, started way back in 2010.
Right.
2009 is when the recession ended. 2010 is when we started having year-over-year earnings growth. A total tangent, Tracy. I was reading about the Wimbledon qualifiers, and the young girl that beat Venus Williams was born in 2004.
That's right. She's 15.
So it's 2009 is when this economic cycle started. We had a 23% year-over-year earnings growth last year for the year as a whole. As long as we are staying flat to 2018, then it means that the overall level of earnings, the dollar level of earnings, is in record territory.
Okay. So when I see that you have 2019, that earnings growth is supposed to be just 0.9% for the year.
That's right.
When I see that, and then I look at what you have for 2015, 2016, which was an earnings recession. So as you described, because of then what was going on with energy. So 2015, it declined just 0.3%. And then 2016, it was at 0.8, which is similar to what we see for 2019. But that earnings recession didn't put us into an overall recession, obviously, because we're still going here.
Right.
So how do we look at this one that's not so great either? Because this is what I'm hearing, like, oh, it's only, barely any earnings growth. It's a sign, but it wasn't a sign the last time.
Yes, I think the using the specific term of a recession for any back-to-back periods of declines in the growth rate is by itself a little misleading.
Okay.
Recession has implications in the aggregate economic terms when the broader economy is going down.
Right.
When we have a real stress and tension in the labor market and in many other areas of the economy, it is just an arithmetic notation of the growth rate because of the base year, as you mentioned in the context of the retailers, being so high that the comparisons are extremely tough for the S&P 500. So we had a tad bit negative reading for Q1, which we all know was a decent quarter otherwise.
Right.
The expectation is for a 3% decline now. My sense is that when all is said and done about the Q2 earnings season, we would probably be in the same vicinity as Q1. The expectation now for Q3, the September quarter, is also for a small year-over-year decline. So if we are being very, what's the word for it, being true to the definition of a recession, yes, 3 quarters, 2 back-to-back quarters of negative decline is a recession, but all the other elements that are associated with a recession are just totally absent.
Okay.
Revenues are growing.
Yeah, that was my next question.
Yes.
The revenue numbers don't look bad here.
That's right. So, and the reason for that is that 2018, while earnings got a huge boost from the tax cut, we know that there's no direct impact on revenues.
Right.
Even though supply-siders would say it has incentivizing effect in the broader economy, perhaps there is. But in the pure accounting and arithmetic terms, when you cut corporate tax rate, it's a boost to the bottom line. It has no bearing on the top line. So the revenue picture is normal.
Okay.
If we didn't have a tax cut last year, we would have a 4 or 5% earnings growth last year. We would have had a 4 or 5% earnings growth this year.
Right.
But since
Okay.
we boosted last year so much, it is becoming difficult for growth to be anywhere in that vicinity, or
Okay.
even positive.
Well, this is really clearing up some of the negative Nellies out there. I feel
Sure.
we're being all negative just based on what the earnings estimates are looking like. Another thing that this is the thing that I feel is different than the last earnings recession, and that I don't recall you even talking about really, is what you already alluded to earlier about the semiconductors and
That's
just the
right.
tech sector in general. I don't
Absolutely.
remember in any of your earnings articles discussing, oh, but wait, there's this bad thing going on in
Yes.
technology that's bringing down the overall numbers. I was kind of shocked at some of how dramatic it is, but the tech sector is huge in the S&P 500.
That's right. The biggest earnings contributor in the S&P 500. It brings in almost 23% of the entire earnings for the index. And then the semiconductor industry by itself brings in almost a fifth of the tech sector earnings. So if we have to focus on areas that are not doing so well from an earnings growth perspective, it's tech in general. And then within tech, a concentrated area is the semiconductor space. There is overcapacity in the industry. There are questions about demand too. This China Huawei thing is playing negatively in that space as well. So growth is very problematic for the semiconductor industry on a year-over-year basis. It has been down the last 2 quarters. It's going to be down 30+% in the June quarter. The expectation is that this is about as bad as it gets. And then the year-over-year comparison starts getting better in the second half. We'll see if that happens, though.
Yeah, we just got earnings from Micron,
That's right.
ticker MU, for anyone who doesn't know. And then now the analysts have had time to adjust their estimates, and I went to go look at those, and they've just been hammered.
Sure.
Like it's down this fiscal year like 45%, but they're expecting another like over 50% decline for the next fiscal year.
And Micron actually wasn't that bad. Applied Materials, which came a couple of weeks before Micron, they had far bigger exposure to Huawei. And they had even negative commentary about the outlook for the second half. So the growth picture for them is even grimmer. So it'll be interesting to see in the tech space, both in the semiconductor area and also outside of the semiconductors, particularly those providers that have more of business or enterprise kind of exposure. Because there is some concern about business spending, both in the U.S. as well as internationally. So the ORCLs of the world, some of the other more enterprise players as to how the outlook for those is.
Okay. And I saw in your one of your articles, you mentioned weak earnings growth expectation for Apple.
That's right.
And you singled them out. So I had to go look to see kind of what was expected over there. And they are supposed to have an earnings decline this year over year.
That's right.
It's only about 3.5%, I think. But is there a reason because of Apple's size
Absolutely.
that it's impacting? Okay.
Yes. So the semiconductors and Apple combined account for a big chunk of the year-over-year decline in the tech sector.
Okay.
If you look at the tech sector, ex-Apple, ex-semiconductor, you're left with only like the Googles and the Microsofts of the world. Then we are kind of flat on a year-over-year basis.
Okay.
Yeah.
Another thing I noticed in kind of the trends for this quarter is that you said that energy is actually supposed to be one of the better sectors, surprisingly. So it's like a reversal. But is that because it's coming off of, these horrible, basically the last couple of years that have been so horrible?
Easy comparisons. It's the inverse of the hurdle facing the broader index. They have the inverse situation of that. So this time last year, the performance of the sector in terms of the total dollar level of earnings was so low that in comparison to that, it looks a lot better. So it's positive. There's no
Right.
one sector that really stands out in terms of growth,
Okay.
but a middling positive is what we are expecting in terms of growth rate for the energy.
Is energy the smallest sector now?
It is in the smallest sector. We as you know, have a relatively different classification than the official Standard & Poor GICS. So we have a sector for transportation, a sector for construction, a sector for the conglomerates. Energy is bigger than those.
Okay.
But it's nowhere near
Yeah.
what it used to be back in the 80s.
Yeah. And what about finance? You said that that's supposed to be positive this year, or this quarter at least, up 3.2% on earnings. Is that kind of muddling through?
It's just muddling through, and it's a victim of all the forces that the market otherwise likes. So the expectation from the Fed of the cutting once or twice or as many times, and this overall environment of very low interest rates. That's been a big reason for, at least on the traditional banking side, to keep their margins in check. And then beyond the traditional banking, even though on the equity side, there has been a lot more deals on the IPOs and also in the M&A side, loan growth has not been as robust as one would expect at this stage of the cycle. So finance is doing okay. It's not doing great as it should have been doing at this stage of the cycle, but it's not dragging down the broader index either.
Okay, let's switch over to the small cap S&P 600 index, because we track that too, but it is harder to track
That's right.
the earnings and the estimates for the small caps. But that's expected to see a big decline as well.
That's right. And it's the same year-over-year comparison issue that's dragging down their large cap peers that's at play with the small caps as well. So it's essentially a story of tough comparisons that we have for the S&P 500 as a whole.
And it does look like the small caps saw a decline of 18.5% in the first quarter. I didn't realize it was that big.
That's right.
And it's only expected to be 8.8%. So maybe
it's possible that it turns positive.
Okay.
That's right.
Yeah.
The
Okay.
the 18% decline that we have for Q1 was a lot bigger before the results had come out. So, as is typically the case, actual results turn out to be better than estimates,
Right.
And that improves the growth rate. So that's what will happen with the S&P 500 expectations too. So earnings are expected to decline about 3%. When all is said and done, we'll probably be close to the flat line.
Okay. Now, what about valuations on the S&P 500? We've been hearing, and every time we hit a new high in the S&P
Sure.
500, it seems like all the bears come out and say, oh, they put up a chart of it soaring, and oh, the valuations, it's the most expensive market in history, and all this stuff. They put out all these, extreme statements. But if earnings are, back on, this is the bottom, and they're back to seeing some growth as it stands for right now going forward, then valuations might not be so bad.
They're not bad. So two things. You point out to the earnings plateauing this year and then resuming growth 2020 and
Yeah.
beyond. And on top of that, the valuation is not just a function of earnings, it's also a function of interest rates. So if interest rates are as low as they are, then a 16, 17, 18 times multiple for the index as a whole is by no means expensive.
Right.
When people talk about the current multiple for the forward 12 months or the current year or next year, being high in historical terms, they are comparing multiples from periods when interest rates were much higher.
Right.
So when you take a view of the full picture, and you keep in mind how financing costs are low, then valuations look fairly reasonable.
Every time Warren Buffett is interviewed on CNBC, somehow it brings up like, oh, is this a bubble? What about valuations? And he almost always answers, well, look at interest rates.
That's right.
As long as they're this low,
Absolutely.
I want to own stocks.
Absolutely.
So
Yeah.
that fits right in with that. Okay, so maybe we should finish up with just a little bit of talk of where maybe some investors should be looking this quarter. Is it still the play because of the trade issues that I want to go smaller domestic, or could some of these big international companies be back in play? Although we've had some already reporting,
Sure.
and it's been a little rocky with
That's
a couple of them already. So we've had maybe 24 or a dozen S&P 500 companies
Have
report already?
That's right, about 20.
And do we get any clues about kind of where we might want to be investing?
It's hard to tell. My personal advice is that these big macro aggregate questions are hard to figure out for anyone. Who knows what will happen with trade? Who knows what will happen with the economy? As long as you stay with companies that have good, sustainable business models that can bring in the revenues period after period, and that have stable demand for their services, you should do fine. So,
Okay.
Adobe, if somebody looks at its performance chart, it's hovering around its 52-week high. But I was telling someone yesterday that it has been doing that for weeks and weeks and weeks for the last many years.
Exactly.
It continues to make 52-week high, and the reason for that is it's the growth in its business and the level of demand for its services. So that's a more mature transition to the cloud. There are others that are on the way there.
Right.
Oracle has been struggling with it.
Right.
It hasn't had as much of a run-up as you have had with other technology companies. I personally like the strategy that Oracle is following. If somebody has a much longer time horizon where they can wade through the quarter-to-quarter fluctuations, I think they will get rewarded. So, if I have to recommend an area, I would say still look in technology.
Okay.
If you want safety, go for these old line companies.
Like a McDonald's. What do you think about ones like that are trading also at their new highs?
Absolutely. I think they have compelling business models. Even if the going gets tougher for these guys, companies that are blue chippy otherwise, strong finances, good balance sheets, they will be the one they'll gain market share, and they'll continue to grow and will continue to reap the opportunities that a downturn will present for them.
Right.
So you have that on the consumer side. You have that in the technology too. You have the Intels and the Ciscos and the Microsofts of the world. They're not as glamorous as some of the newer fangled companies, but these are stable companies. They pay dividends, at times even growing dividends, and those are good companies to have. The banks are very good too, Tracy.
Yeah,
Goldman
they just
Sachs,
raised dividends.
They just raised dividends. Goldman Sachs, it appears to be becoming kind of a utility.
I know.
So
I'm kind of shocked by the developments of Goldman.
That's right. so it's these dividends eventually add up
They
to
do.
quite a fair amount of the total return.
They do. And you might be surprised, or maybe not, to learn that millennials are really into dividends. They
That's
like
good
the
to know.
REITs even. They're buying those. But if you can get a tech stock with the dividend,
Sure.
that's why a stock like Apple is popular.
That's right.
Because that's pretty, they're buying back and they're paying.
That's right.
And then Microsoft, like you said, I like Microsoft a lot for their gaming business, even though it's a smaller portion of their overall business. But they're starting to put some money into the gaming side now.
Yep.
So yeah, there's a lot going on out there. Okay, so let's recap some of the tickers we talked about today. We had Micron. We did talk about them, MU, but their earnings estimates going the wrong way with that one right now. Apple, AAPL. Then we had Adobe, ADBE. Oracle is ORCL. McDonald's is MCD. Microsoft, MSFT. Goldman Sachs is GS. And just buying some ETFs, you could buy the S&P 500 SPY or the S&P 600 SLY. But as always, be sure to subscribe here at the Market Edge so that you don't miss a single episode, because we're going to be talking about all these things going forward for the second half of this year. And as always, the R word is on everybody's tongue. So I'll be having more episodes on the recession. So you don't want to miss a single one. You can get us on Apple Podcasts, and you can get us on SoundCloud, and we're now on Spotify. But be sure to get us somewhere, and I'll see you all again next week with some more stocks.